The non-farm payroll report released on Friday delivered mixed results. Job growth came in at just 12,000, significantly below the expected 113,000, and prior figures were revised downward. This stands in stark contrast to the earlier released ADP private payroll report, which had far exceeded expectations. The U.S. unemployment rate, in line with forecasts, remained at 4.1%. Additionally, initial jobless claims were lower than expected, while average hourly earnings exceeded expectations, growing 0.4%. In terms of manufacturing, the U.S. market manufacturing PMI surpassed expectations, while the ISM manufacturing PMI fell short. The difference between the two can be attributed to their varying sample sizes and the types of companies they track. After the release of the data, markets experienced notable volatility. U.S. equities initially rallied but gave up part of the gains, while Treasury yields and the dollar briefly plunged before quickly recovering. Notably, the 10-year Treasury yield once again hit a new cycle high. Next week, the Federal Reserve's FOMC meeting takes center stage. CME FedWatch tool indicates a 96% probability of a 25 basis point rate cut. Nick Timiraos, the Wall Street Journal's chief reporter and known Fed insider, commented that while the unemployment rate appears steady at 4.1%, if we factor in the second decimal point, it actually ticked up from 4.05% last month to 4.14%. Moreover, the weaker-than-expected non-farm payroll figure could be attributed to short-term factors like the Boeing workers' strike and the impact of recent hurricanes. Coupled with stronger-than-expected inflation and wage growth, lower-than-expected GDP, and the mixed nature of the non-farm report, market expectations for a 25 basis point Fed rate cut next week remain intact. The reason behind the initial drop and subsequent recovery in both the dollar and Treasury yields can be traced to the market's view that the sharp drop in employment numbers was driven by temporary factors. On the equity front, tech stocks led the rally, with Amazon and Intel exceeding expectations. Combined with generally decent economic data, the U.S. stock market did not extend the losses from Thursday's sell-off. A wide range of factors and uncertainties have been weighing on the markets recently, and given the sharp rally in previous sessions, some sell the news action is to be expected. I will provide further updates once the Fed meeting, earnings reports, and U.S. elections have concluded next week. Looking ahead to the Fed's November FOMC meeting, while a 25 basis point rate cut seems almost certain, the key focus will be Fed Chair Jerome Powell's tone. Will he signal a dovish or hawkish stance? And how will he address the recent surge in long-term U.S. Treasury yields? Recall that in October 2023, even though the Fed did not hike rates, the 10-year Treasury yield briefly hit 5%, which led the Fed to halt further rate hikes, stating that the rise in bond yields had already tightened financial conditions sufficiently. Will Powell now lean more dovish due to the recent bond yield spike, or will he remain vigilant about the risks of inflation rebounding? We'll have to wait and see.